Welcome to the Deep Dive. This is where we take, well, a whole stack of information, official reports, market chatter, you name it, and really try to boil it down to what matters for you.
That's the plan.
So today, we're embarking on a pretty crucial deep dive. We're looking at the very latest U.S. labor market data. This is for August 2025.
Just came out.
Exactly. And look, this isn't just about, the headline numbers. It's about these surprising ripple effects, how it hits global financial markets, what the Fed might do next.
Big implications there.
Huge. And even like specific industries and companies. As we dig into these reports, I think we're going to find some connections that might actually reshape how you're thinking about the economy right now.
Yeah, there's a lot under the surface.
Okay, let's unpack this. So our main focus, where we have to start, is the U.S. Bureau of Labor Statistics, the BLS. Their employment situation report for August.
The big one, the monthly jobs report.
Right. Gives us that vital snapshot, payrolls, unemployment, all of it.
Mm-hmm.
And it always has that embargo, 8:30 a.m. Eastern Time release.
Yeah, it keeps the playing field level.
So everyone gets it at once. Now, the headline, the number everyone was watching, total non-farm payroll employment. Well, it barely changed in August.
Yeah, changed little was the official term.
Added only 22,000 jobs. I mean, that's a real slowdown, isn't it? It continues that trend we've seen since, April?
Exactly, that modest gain, just 22,000 jobs. It really does mark a significant deceleration. I mean, put it in perspective, right?
Yeah.
The average monthly gains over the past year were much, much higher.
Right.
And the unemployment rate itself, it just held steady, 4.3%. 7.4 million people unemployed, also pretty much unchanged from July.
Okay, so stable headline rate?
Stable headline, but, and this is where it gets fascinating, maybe one of those aha moments, you have to look at the long-term unemployed.
Okay, those out of work for a while.
Yeah, 27 weeks or more. That number stayed at 1.9 million in August. But here's the kicker. It's actually up by 385,000 over the past year.
Wow, okay. That's a big jump over 12 months.
It is. And now that group makes up 25.7%, over a quarter of all unemployed people. And look, this isn't just some fleeting statistic. It could signal a real structural issue.
How so?
Well, these aren't folks just briefly between jobs. They're really struggling to get back in. That can lead to, skills getting rusty, lower future earnings. Economists call it the scarring effect.
Right, it has lasting impacts.
Exactly. So even if that main unemployment rate looks okay, this specific group faces these persistent hurdles. And that can, drag down consumer confidence, limit future growth potential.
That increase in long-term unemployment is quite striking. Does that figure imply a structural issue in the labor market, or is it simply a lagging indicator of a cooling economy? What's your take on how the Fed might interpret that specific detail when they're looking at their employment mandate?
That's a fantastic question. And honestly, it's probably a bit of both. Any slowdown could eventually push up long-term unemployment.
Sure, makes sense.
But the sheer size of this increase, 385,000 over a year, that does suggest something maybe a bit deeper is going on.
Like a mismatch.
Could be. It tells the Fed, look, overall job creation is slowing down, yes, but there's also this persistent difficulty for a pretty big chunk of the workforce to find stable work again. So it complicates their picture, right? It's not just about juicing new job growth. It's about maybe addressing an underlying mismatch, or perhaps a lack of the right opportunities for people out of work that long. It could signal, a less healthy labor market than just the headline numbers suggest.
Okay, let's dive deeper into the sectors then. Based on the input sources, we saw some interesting shifts there too. Healthcare, for example.
It's still adding jobs.
Still adding jobs, yeah. 31,000 in August. But even that was below its average monthly gain over the last year, which was more like 42,000.
So still growing, but slower.
Right. Social assistance also trended up, added 16,000 jobs. Those are often seen as, more resilient sectors, maybe less tied to the economic cycle.
Generally, yes. Demographic drivers, government funding, often play a role.
But then these gains were partly canceled out by losses elsewhere. Federal government employment that fell by 15,000. And it's down, get this, 97,000 since its peak back in January.
Wow, that's a significant drop in federal jobs.
Yeah. We also saw losses in mining, quarrying, oil and gas extraction down 6,000, wholesale trade down 12,000, and manufacturing also down 12,000.
And that manufacturing dip, part of it was strike activity, right, and transportation equipment.
That's what the report attributed some of it to, yeah.
Okay. So this distribution of job changes, it's quite telling, I think. You've got resilience in some services like healthcare, social assistance, maybe reflecting those ongoing demographic shifts, maybe some recession proofing like you said.
But the other side.
But the declines in manufacturing federal government,
Yeah.
they really highlight that broader economic cooling. That federal drop is particularly interesting, suggests maybe targeted cuts or hiring freezes hitting. In manufacturing, even with the strike caveat, it still points to broader softness in the goods-producing side of the economy. Now, what about wages? That's always key for inflation watchers.
Good point. Average hourly earnings, they rose by 10 cents, that's 0.3%, hitting $36.53 in August.
Okay, 0.3% month over month. What about year over year?
Year over year increase is now 3.7%.
3.7. Okay, still above pre-pandemic levels, but definitely moderating from the peaks we saw. And the average work week?
Any change there?
Nope, steady. Remained at 34.2 hours. That's a third month in a row. So not seeing employers cut back hours broadly yet.
That's an important indicator of demand, yeah. Holding steady is, well, it's not negative at least. We also need to mention the revisions, right? BLS always revises the previous 2 months.
Ah, yes, good catch. June's number was revised down by 27,000 jobs.
Okay.
And July's was revised up slightly by 6,000.
So net-net.
Net-net, employment for those 2 months combined was 21,000 lower than we previously thought. See, those revisions matter. They can subtly shift the whole narrative. It suggests the labor market might have been even a touch softer back in early summer than the initial report showed.
Okay, so that's the main BLS report. But beyond just who's employed or looking, we need to get a sense of the dynamism, right? The churn in the market.
Exactly. How many openings are there? Are people quitting confidently? Are layoffs picking up?
And for that, we turn to the JOLTS report, Job Openings and Labor Turnover Survey. We got the July data for that on Wednesday, September 3rd.
Right, so it's a bit lagged compared to the payrolls report, but still crucial.
And what did it show? Well, job openings were, again, little changed, around 7.2 million.
Still a high number historically, but definitely down from the peaks.
Yeah. And hires and total separations, they also stayed pretty stable at 5.3 million each. But inside those separations, there were some interesting moves.
Like what?
Quits, people voluntarily leaving their jobs, often seen as a sign of confidence, they actually increased in professional and business services by almost 200,000.
Interesting. So still some confidence in that sector.
Seems like it. But quits decreased in construction and also in transportation, warehousing, and utilities.
Okay. So a more mixed picture on quits, depending on the industry. What about layoffs?
Layoffs and discharges, largely unchanged overall, but again, sector differences. A decrease in professional and business services, fewer layoffs there by 130,000.
Okay. Consistent with the quits data for that sector.
But an increase of 5,000 layoffs in the federal government.
Ah, okay. So if we put the JOLTS data together with the BLS report, even though JOLTS is for July, it really does reinforce that story of a labor market that's adjusting. Not crashing, but definitely recalibrating.
How so?
Well, that increase in federal government layoffs in JOLTS, it lines up perfectly with the falling federal employment we saw in the August BLS report. It suggests those are targeted cuts.
Makes sense.
And the rise in quits in professional services, even as layoffs fell there, that might mean there's still some churn in that sector. People moving, maybe for better pay or roles.
Yeah. While other sectors like construction are seeing less movement, fewer quits.
Exactly. So this combo of reports, it paints a clearer picture, I think. Job growth is slowing, yes, but there are also these shifts happening underneath. It's an underlying recalibration, not just, minor bumps.
Okay, one more piece of the puzzle before we get to market reaction. The weekly jobless claims just came out yesterday, Thursday, September 4th.
Right, the initial claims data gives us a very timely, albeit noisy, signal.
For the week ending August 30th, initial claims actually increased by 8,000, came in at 237,000.
Okay, little tick up. What about the 4-week average? That smooths things out.
That also rose, yeah, up to 231,000. The insured unemployment rate, though, that stayed put at 1.3% for the week ending August 23rd.
So claims are maybe ticking up a little, but not dramatically spiking yet. Any interesting state-level details?
There were. New York saw a noticeable increase, up over 1,400 claims. Texas up over 1,200.
Any reasons cited?
Often linked to specific industries. Transportation and warehousing layoffs mentioned for New York. Information sector layoffs in Texas.
Okay.
Meanwhile, Iowa actually saw claims decrease by over 1,200, mostly due to fewer manufacturing layoffs there.
So it shows how these pressures can be uneven geographically, too. Gives us that granular view.
Exactly. Okay. So we've laid out all the data, the raw numbers, but how the market actually reacted to all this on Friday, that's often where the story really takes shape.
Absolutely. The interpretation is key.
So what happened? How did the markets digest this cascade of labor data on Friday, September 5th? Well, as various news commentary pointed out, U.S. equity markets were mixed.
Yeah, not a straight line reaction.
No. The S&P 500 ended down about 0.4%. It had been down almost 1% earlier, so it paired some losses.
Okay.
The Nasdaq 100 kind of struggled for direction all day, eventually just, quote, squeaking into the green.
Barely positive then.
Yeah. But the real outperformer, interestingly, was the Russell 2000, small cap stocks. That was up about 0.4%. And the thinking seemed to be it was getting a boost from the bond market.
Ah, okay. And that makes sense because the bond market reaction was not mixed. It was pretty decisive.
Tell us about that.
Well, the 2-year Treasury yield, that's the one most sensitive to Fed policy expectations.
Yeah.
It saw a really significant drop, down 8 basis points at one point.
It's a big move for the 2-year, 0.08%.
Huge move. It closed down 7 basis points on the day.
Yeah.
And that marked the 4th straight week of declines for the 2-year yield.
Wow. 4 weeks down.
Yeah. And according to various news commentary, this sent a really clear signal. Basically, traders are, quote, locked and loaded for the Fed to cut rates, possibly as soon as their meeting in just 2 weeks.
Locked and loaded. So this weak jobs report really cemented those rate cut expectations.
It definitely seems to have tipped the scales in the market's view. They're front-running the Fed, anticipating an easing cycle is coming, maybe sooner rather than later.
So if the market is locked and loaded for cuts, that implies a pretty strong belief this labor data gives the Fed the green light, right? Market participants pricing in 23 basis points of cuts soon, maybe even anticipating 3 cuts by the end of the year.
That's what the futures market was indicating, yeah. A significant shift towards expecting easing.
And that sentiment just rippled everywhere, didn't it? The dollar weakened again, gold surged.
Yeah, gold hit $3,600 an ounce, first time ever, driven by what was described as fears turning into big demand. Bitcoin saw flows too, basically weaker dollar, lower yields. That tends to boost assets like gold.
But hang on, earlier we heard about concerns from folks like former Fed President Thomas Honig, concerns about persistent inflation. Is the market just ignoring that? Are they too focused on the jobs number here?
Well, that's the absolute core of the Fed's dilemma right now. It's incredibly complex. Stepping back, the Fed has that dual mandate, maximum employment and price stability.
Right, gotta do both.
And as Honig pointed out, inflation, especially core PCE, the Fed's preferred measure, it's still stubbornly above their 2% target. Has been for over 4 years now.
4 years above target. Yeah, that's persistent.
Exactly. So Honig's concern, as reported in commentary, is that if the Fed cuts rates now, with inflation still elevated, they risk their credibility. It could look like they're implicitly accepting, say, 3% inflation instead of sticking to the 2% goal.
Which he argued isn't really price stability anyway.
Right. He called 2% stable inflation, not true price stability. And then you add in other potential pressures. He mentioned the recent expansionary budget bill, ongoing tariffs.
Yeah.
Those could push prices up.
Making the Fed's job even harder, trying to thread that needle.
Precisely. It really does sound like a high-wire act. They're balancing these very strong, often opposing forces, slowing labor market versus sticky inflation.
Okay, but there's another perspective too. Michelle Girard from NatWest Markets, her view, according to commentary, was a bit different.
Yeah, she offered a slightly more, maybe balanced view for the equity market at least. She acknowledged the labor market has softened enough to, open the door for rate cuts.
Okay, so agreeing on that point.
Yes, but she also noted that stocks seem to be taking some comfort from the fact that consumer spending is still holding up, and company profits and productivity have been strong.
So kind of a soft landing vibe. Labor cools, but the consumer and companies are okay.
Perhaps. But she also highlighted something really important. The yield curve is steepening.
Okay, explain that. Long-term rates aren't falling as fast as short-term rates.
Exactly. That differential, that gap is crucial. It's another one of those aha moments, I think.
Why is it so significant?
Because a steepening yield curve, in this context, suggests something interesting. While the market is betting heavily on the Fed cutting short-term rates, soon pushing those 2-year yields down.
Right, the locked and loaded part.
The fact that long-term rates aren't falling as much, or are even rising relatively, signals lingering worries about the future.
Worries about what? Inflation down the road?
Could be. Worries about ongoing fiscal policy, government borrowing needs, maybe concerns about those tariffs and their impact, or, the risk that if the Fed eases too much now, inflation comes roaring back later.
So the bond market is telling two stories. Short-term relief, long-term caution.
That's a great way to put it. Short-term optimism for Fed cuts, but definitely some long-term caution about inflation, fiscal health, maybe even slower growth potential. It's a very nuanced outlook, even with all the immediate excitement about rate cuts.
Okay, fascinating stuff in the macro picture. So what does this all mean for individual companies, specific sectors? Let's shift focus there. We saw some big moves highlighted in various news commentary. Tesla, for instance.
Yeah, Tesla had a strong week.
Shares were up 4% just on Friday. That helped it gain 5% for the whole week. Reached its highest level since February, apparently.
And this is happening amidst that huge new pay package proposal for Elon Musk, right?
Exactly. The one potentially worth, an unprecedented $1 trillion?
Yeah, aiming to incentivize him to drive Tesla's market cap to like $8.5 trillion in 10 years, as they branch into AI and robotics.
I mean, the numbers are just staggering.
They really are. And it immediately brings up those corporate governance questions, doesn't it? And questions about value versus maybe just vision.
How so?
Well, Ross Gerber, CEO of Gerber Wealth Management, he was quoted, kind of humorously, saying the package seems crazy and out of control.
Yeah.
Especially with those fantastical goals.
Fantastical is one word for it.
Right. And it makes you, the listener, ask that important question. Is that Elon Musk premium baked into Tesla's stock? That PE ratio over 200 compared to Ford under 10. Is that justified by this grand vision of pivoting beyond just EVs into robotics and AI?
Or could someone else maybe lead Tesla towards its original mission more effectively, sustainable transport and energy?
Exactly. It's a huge debate. And that shareholder vote coming up in November, that's going to be really critical. Will shareholders buy into this grander vision at such an extreme valuation, especially when so much hinges on one person?
Yeah, a lot riding on that vote. Okay. Other companies making headlines, and it really feels like AI is just everywhere right now.
Definitely the dominant theme.
DocuSign, for example. Shares jumped quite a bit after they boosted their full-year billings forecast. They're looking at $3.3 to $3.6 billion now.
And they credited AI for that boost.
They did. The CEO, Alan Thygesen, basically said their deep understanding of agreements lets them use AI to extract more value. Makes sense.
Yeah, applying AI to their core business.
And then the really big one, Broadcom. Shares just skyrocketed Friday, up over 16% at one point during the day.
Whoa. What was the news there?
Reports that they're collaborating with OpenAI, designing a new AI accelerator chip aiming for 2026.
OpenAI. That's huge. Another company jumping deep into the AI hardware race.
Yeah, and it led some commentators to speculate, should the Magnificent Seven tech giants maybe become the Great Eight now, adding Broadcom?
Yeah, the club might need a new member. But seriously, these examples really show how AI innovation is driving massive market moves, massive reevaluations of company potential, even when the broader labor market is cooling.
It's creating its own weather system almost.
Exactly. It's this distinct narrative for growth, and it's attracting a ton of capital, even with all the broader economic uncertainty. These companies are seen as having this clear path to future revenue because of the tech.
But it wasn't all good news, right? Not everyone's riding the AI wave successfully.
No, definitely not. Conversely, Lululemon shares, they fell hard, almost 19%.
Ouch. What happened there?
Analysts were pointing to internal marketing missteps, some pricing mistakes, execution issues, basically.
Okay, and Kenvue also saw a drop.
Yeah, Kenvue down about 10% too. So these contrasting performances really underscore that even with these big macro shifts happening, company-specific stuff, strategy, execution, market narrative, it's still absolutely crucial.
A rising tide doesn't lift leaky boats, essentially.
Precisely. A strong macro tailwind helps, sure. But company-specific headwinds can still really hurt, even well-known names.
Okay, one last thing on the company front. The IPO market seems to be waking up.
Yeah, definitely seeing signs of life there. Various news commentary reported that this upcoming week is set to be the busiest for U.S. IPOs so far this year.
Really? How much are they expecting to raise?
Potentially over $3 billion.
Wow. Any big names expected?
Quite a few interesting ones. Klarna, the fintech player, Figure, which is in the blockchain space, Gemini, the crypto exchange, StubHub, the ticketing platform.
Okay, diverse group.
And also a Blackstone-backed company that does HVAC systems specifically for data centers. That one was being called the hottest in town.
Data centers again. Ties back to the AI theme.
Exactly. So this surge in IPO activity, especially across such different sectors, fintech, blockchain, data centers, it suggests that even with all the macro uncertainty we've discussed, there's still a lot of capital out there looking for growth.
An appetite for risk returning. Seems like it. Or at least a belief in specific long-term growth trends, like that huge demand for data centers powering AI and digital economy. But there's a caveat. Some analysts noted that demand for certain types of IPOs, especially maybe some private equity-backed ones, might be more of a slower build.
Meaning the market is still being selective, not just a free-for-all.
Exactly. It indicates a discerning market. Investors aren't just throwing money at everything. This mix of interest reflects a market trying to find its footing, trying to balance established names with these innovative disruptors, all while navigating these shifting economic signals. Capital isn't just sitting idle, but it is being deployed strategically.
Okay, so bringing it all together as we wrap up this deep dive, it's really clear that August's jobs report was a major moment. It definitely seemed to solidify those expectations for Fed rate cuts.
Yeah, the market reaction certainly pointed that way.
And it prompted this really nuanced response across different markets. But as we've explored the underlying economic picture, it's way more complex than just bad news is good news for stocks, isn't it? Oh, absolutely. It's this whole tapestry, right? You've got slowing job growth, yes, but also that sticky long-term unemployment issue. You've got sector resilience mixed with sector weakness, and all of it is being viewed through this lens of market optimism, which itself feels a bit cautious underneath.
Yeah, that bond market signal was key.
Exactly.
Yeah.
And the Fed, as our sources show, they're walking this incredibly narrow path. They have to balance supporting employment, tackling that persistent inflation, and now deal with these rising long-term yield concerns too.
So the market's reacting with both caution and opportunity.
I think so. Seeing selective strength, especially in those AI-driven growth stories, while still grappling with the bigger picture implications in fiscal policy, the cooling labor market. And it leaves us with this really important question, I think, for everyone listening.
Cheers.
Can the market's really strong optimism about rate cuts actually coexist long-term with these underlying inflation pressures and this subtly slowing economy? Or, are we potentially setting ourselves up for another policy surprise or pivot down the road?
A delicate balance indeed, with potentially huge implications.
Profound implications.
So as you navigate the headlines, plan your next moves, really consider how these shifting economic signals from the labor market's slowdown, the nuances within it, to the Fed's upcoming choices, how all of this will ultimately reshape not just the big market indices, but the very fabric of how companies innovate, where capital decides to flow, and ultimately how we all participate in this constantly evolving economy. We hope this deep dive helped make some sense of it all.